let's start with maybe introduction. So let's just take a minute just to do an quick introduction of yourselves. So Barker, it would be good just to introduce yourself and I guess what side of the debt and financing area you're on.
Happy to do so. Thank you very much for having me here. Yeah, my name is Barka Mehmedagic. I'm running the treasury of Commerzreal. Commerzreal is a 100% subsidiary of Commerzbank, the German universal bank. As such, we serve our institutional and retail clients with real assets, infrastructure, mainly renewable energy worldwide, but also real estate. And my special role is sourcing debt. So I'm on the borrowing side, talking to trusted relationship partners, bankers, regionally, but also internationally when we do investments abroad.
Perfect. Duco.
Yeah, happy to continue. Hi there, and Richard, many thanks for the invite and pleasure to be here. Duco Moog, heading the treasury and debt financing team of Seabury Investment Management in EMEA. Responsible for a loan book just over 10 billion in euros. That is core product, core plus product, but also value add. I'm also on the borrowing side, so nice to meet you. And from development financings, portfolio financings, fund level debt, RCF facilities, debt capital markets, it all comes across. So that's in a nutshell my role within the firm.
Great, thanks very much. Oliver, over to you.
Yes, my name is Oliver Plath, and first of all, great being back in the cinema after all those Netflix times. Has been a while. I'm a partner in the real estate and finance boutique law firm Kutsera, and also a managing partner in Arcida Advisors. Arcida Advisors is a holistic and fully integrated advisor for the NPL industry. We act as a servicer, but we also act as an investment advisor, for example, for Nexum Debt Potential Fund in Luxembourg. And our main focus is the DACH region, and mainly we care about our home market, Germany.
Great. Carolis.
Hi, Richard. Thank you for having me. Hello, everybody. I'm the executive director of WP Carey, based out of London, responsible for investments across the European region. WP Carey is a sale-leaseback specialist, a long-income investor, and sale-leaseback is an alternative tool for financing as well. So I think we're going to discuss that.
Yeah, and that's interesting. We'll pick up on that later, because that's definitely something that you're seeing in the US, which may be coming more over to European markets as well. So very interesting panel here. We've got a mix of both the borrowers, but also different types of financing. And we'll be talking about, what we see in terms of the outlook for the market, some of the challenges in the market, what we're seeing as well, what types of lending is being done, the structures of those, where we see that heading. And of course, if you've got comments or if you've got questions, please raise your hands, stand up, sing, shout, whatever is necessary to get my attention. And I will make sure that we also answer your questions. So it's designed to be interactive and an open discussion. So please do come in with those if you've got things that you want to contribute or add. But Barker, maybe just starting with you, I guess, a lot of changes over the last year in the market. How do you see those? How have those affected your kind of day-to-day world, if you like, as a borrower? And then we'll also pick up with you, Duco, as well on that.
Sure. First of all, I think the markets are very shaky. We are very happy that we bank on existing relationship. That's more worth than ever. Though the investment activity is a little bit lesser than we were used to, for instance, in the times 2017, when we financed also huge portfolios, billion euros and even more. We are facing still, for us speaking, liquid markets, but we are also on the conservative side of refinancing. So our needs are more core products and locations are more core plus. And so the banks, they analyze more the sponsor quality than the quality of each asset. But saying this, we see that the size of loans has declined, so it has decreased. if we would have now to refinance a bigger portfolio, that might end up to putting more partners together instead of what we saw probably a couple of months ago. So saying this, it's a very interesting market, especially when it comes to buying assets, to be there as an equity player, and keep your hands and eyes and ears open. But so far on the refinancing, that I'm saying this, the capital cost, of course, that's something which has increased. But being on the conservative and low leverage side, we are still okay.
Okay, good. And Duca, it'd be interesting to get your sense, I suppose, of what how you've seen the market, because in some ways everybody was slightly more positive. Particularly, let's look at the interest rates, for example. Everybody was quite positive about that as we turned into January, more positive of a feeling than at Expo Real, for example. So I suppose what's your sense of that, and where do you see interest rates going? I suppose nobody has a crystal ball, but and how is that influencing? I guess that particularly the borrower side, but also then what you're seeing from the banks, is that reducing the amount that banks are willing to lend? What's the situation?
Yeah, thanks, Richard. I think it's the big theme, this MIPIM. It's all about interest rates. If you look back since summer last year, everybody was speaking, certainly at Expo, about increasing interest rates. In my view, it's not only about the increasing interest rates, it's about the volatility in the interest rates, right? You need a forecast, you need a stable cash flow, you need to be able to underwrite debt terms in the long run before you acquire real estate and before you pitch on new transactions. It's the volatility that's difficult, right? What you have seen last weekend and Monday morning, a euro 5-year swap rate decreased from 3.3 to just below 3%. That's 30 bips, If the yields, which are obviously moving, but if the yields are in this range of 3, 4, maybe towards the 5%, then 30, 40 bips change in debt terms is tremendous and is a deal breaker, right? So this volatility is killing us, to be honest, since summer. I don't see that changing on the short term, Richard. I think, the central banks are driving a huge volatility in the market, and you have the major monthly events like Christine Lagarde with obviously impact on, now I pronounce 50 bips. Well, guess what? In most instances, those 50 bips were already priced in by the market. However, what she add to that in the story, and what she shares in a forecast, whether that's another 50 bips or 75, that again creates volatility. So I think that the central bank needs to do much more in terms of trying to steer the market, which is obviously easy said because they will get revised inflation figures that might be higher than expected, and they need to hike much more than general expected in the market, and there you go again, you have the volatility. So long story short, I think where we started the year with in euro at least, euro swap rate around the 3-ish%, I think that's the new normal, and the yields need to adjust to that. We have seen the 3.3, obviously with the events over the weekend it came down a bit, but I think this is sort of in a bandwidth where it will stay the rest of the year. And I keep my fingers crossed that sort of the volatility will go down a bit.
Okay, good. And Oliver, what's your sense of that? We've had a couple of conversations, panels in Frankfurt as well around these topics. How have you seen the market changing, I suppose, since we last met?
I can absolutely confirm what you just said. It is real now. And we just saw I can only speak for the German market, but 2/3 of the mortgage-backed finance is due for repayment in 23, 24. And right now I saw the first refinancing. And right now, what's it, 12 months Euribor, 3.8 something. I saw the first refinancing with a margin of 3.25. So you're above 7%. And this is a complete game changer for the refinancing. And what we see right now, and everyone I speak about a German NPL market is like, you're in the wrong place, right? Because the NPL debt ratio is an historical low in Germany at 1.83%. But I believe, and when I talk to banks, they are a bit complacent because what we see is, when we speak to banks, when we speak to investors, is that you have lots of covenants, covenant breaches at the horizon. The costs are much higher right now. And if you ask, for example, the German Association of Loan Purchasing and Servicing, BKS, they expect an NPL volume of 38.1 billion, in 24. And every time you talk with German market players, they are like, they talk about the German banks, but that's not the whole picture. You also have the alternative debt providers who raised capital like crazy in the last few years, and they don't have much experience and stuff to work out those debts. And we saw just last week in the German Immobilienzeitung that we can expect up to 16 billion of NPLs or distressed debt from those debt providers. So it's a real market and it's coming.
And there's an additional aspect. The one is NPL and to turn around this loans, and the other aspect is doing best of ESG in these assets. They're also on the balance sheet of the banks. Yeah, so it might bring additional pressure.
Absolutely, and what always surprised me when I speak to banks, even Landesbanken, who should be like super sophisticated, when I mention the NPL backstop, and the NPL backstop is live since June 21, right? So they have to secure all risk with their core capital, with CET1 capital, not only for NPLs, which are, repayments due for 90 days plus, but also for all forbearance measures. And if you talk to bankers, they don't even know about that. So they really face the risk that they can't provide new capital into new business. And this is why even Raimund Rösler from BaFin said heavy storms are gathering about the German banking market. And no one seems to even notice.
Okay, I want to pick up a little bit I think that's a really interesting point, and and we'll pick that up a little bit more in terms of some of those challenges that we're seeing. But I'd be interested to get your perspective there, Carlos, just in terms of using sale and leaseback as a model for refinancing rather than, because we haven't really seen it from that perspective here in Europe, or certainly I haven't noticed it particularly. But that's a model you were saying was coming over particularly from was seeing a lot in the US at the moment, and is something that you're maybe thinking about using more over here in Europe.
No, absolutely. I think a couple of things I'll reflect on the things you discussed. As you said, Expo was, people were negative, and now MIPIM people are positive. My prediction is next Expo people will be a lot more negative again. I'm very bearish on the economy. I'm bullish on the investment market. I do agree what you say. A lot of PE shops did a lot of acquisitions on very, very cheap debt, short-term debt is coming up for refinancing. And refinancing that is going to cost a fortune. So there's a lot of PE shops reaching out to us, and obviously our competition, to consider a sale leaseback, selling off some of the assets of the business that they bought to finance the debt that they need to repay. Also, we're seeing a lot of industrial companies reaching out for sale leaseback, because they also have short-term debt, 5-year debt that is coming up to maturity 2024, even this year, to do a sale leaseback, offload some of their value in the real estate that people were discussing in the previous panel, and get that debt repaid. And that's a solution that's very attractive. WP Carey has always been known as a sale leaseback specialist, and sale leaseback it started out as an alternative tool to financing. So you can go to a bank, you get your 60-70% LTV loan. Sale leaseback, you get your 100% LTV loan that you never have to return. And coming to MIPIM now, it's my 8th year. Every time you propose a sale leaseback, someone they say, "Oh, Carlos, why the heck should I do a sale leaseback? I get 1% money from the bank. You're offering me, 4 or 5%. The spread is 400 basis points. Why should I do it?" Now, bank money is like 5-6%. Sale leaseback you can do at 7-8. Spread is 100 to 200 basis points. It's a lot narrower. So definitely become a lot more attractive tool for companies to consider. I'm not sure if I answered your question, but
No, I think that's interesting. And generally, do we think that the banks are stepping back? I mean, obviously, if you've got the assets in in their loan book at the moment are reducing, they've got to keep the same amount of active funds there. So that should suggest that there will be less activity from traditional bank lenders, and therefore more of an opportunity for the non-bank lending side.
I'm happy to respond to that. I'm a bit more positive though, with obviously with caution. I think liquidity in general is there. Liquidity is also there from the banks. However, you can't ignore certain themes. I think one theme is definitely you refer to, let's say, the loan size. I think it's a fact that the syndication market is on hold, right? I think lenders have difficulty with providing full underwrites. Why? Simply because they don't know the strategy of their co-bank, although they did many deals together in the past. So they want to have control. They will do a full underwrite on a small ticket, or alternatively team up. I think there's a flight to core. So you will see a big distinction between the prime and the core deals versus the rest. Almost in every asset class. ESG is a big theme. So if you tick all those boxes, if you are a current client because you have the relationship angle, your banker will be there. The cost will be slightly higher. The LTV on day one, it's not a big topic. Why? Because the banks are cash flow forecast and the interest rates went up. Even the margins went probably up, although less material. So I think all in all, it needs to fit. It needs to suit the profile. It needs to meet the strategic, the strategy of that bank. You need to know who you do business with, and on the banker side, well, RWE went up, right? So if they have more non-performing loans or defaulting loans, but let's start with the healthy loans. Even on the healthy loans, they need to keep more equity on their balance sheet compared to a few years ago, which will only increase over time when Basel 3.1 or Basel 4 will come along. So I think liquidity, yes, it is there, but absolutely with caution. And it's very important for investors to know what they can get in today's market.
And what do we make of the of obviously the banking issues in the US at the moment? Is that the start of something, or is it just I mean, I remember before when it was kind of 2008, everybody thought, oh, well, that's all right. And then it suddenly wasn't all right. But what's our sense of that? Do we see that as a kind of isolated issue, and actually the rest of the banking sector is remarkably strong? Does anybody have a view on that?
I can share my view very, very briefly. I think nobody really knows. You get so many different conflicting opinions and information. I was reading yesterday. You have the founder of Pershing Square Capital, Bill Ackman, saying, the government should bail out all deposits, all the ones above 250K. And then you have the founder of Citadel Hedge Fund saying, you shouldn't do it. So two titans of the industry who are successful in their own right have very opposing views. I'm more leaning towards the capitalist side, where I think you should let them fail. And I think essentially the US government is saying the banking sector is extremely safe, so no one should worry, but they go to such extreme lengths to guarantee the money that it's contradicting their initial message. So I don't think the government even knows how healthy or unhealthy the market is.
I also believe SVP is not GFC 2.0. I believe as long, and especially for us Europeans, as long as the European real estate market is in good order, we don't have a tsunami, so to say.
Okay, good. I wanted to pick up a little bit on what is being lent on, what is not being lent on, just to get some views from that side as well around the sectors. Has retail reached a bottom now where people are happy to do that? Is there an investment focus on that? So I guess, what are you guys borrowing on? And what are people lending on?
I can start for Commerzreal. We have been active in the field of residential and office in the past, very active in the past 2 years, but we are serving all asset classes and also started with logistic. Now, when we see the prices are a little bit falling, that's the part when we jumped in logistic. So far, the appetite from banks were okay, so we managed to get the refinancing. As saying this, last year, especially the regional programs from some regional banks or KfW programs, that was a little bit a shock for the market, where they just stopped providing those kind of incentive loans. Thankfully, we had negotiation ongoing, so we could just sign in for such programs. But we have seen and talked with other developer, they missed out to get such kind of loans, which are on the one hand attractive from the interest rate, but then they have some amortization advantages in comparison to the standard loans. So that's something which is really missing. So here again, I can just request the political scheme to support the real estate, but also the renewable energy industry a little bit more to reach our goals towards become a greener environmental. But saying this from the core side of asset classes, either residential, either office, multifamily, student housing, as long as it's well balanced, the sponsor is in place, the track record is given, there was appetite, for, at least from the German banking side, but even from the European bankers, French bankers, Dutch banks, we have faced a prudent and balanced refinancing portfolio and appetite.
Okay, good. And Duca, from your position, I guess is that the same in terms of the mix of borrowing, the mix of assets that you're looking for? And I guess it'd be interesting as well to see, I mean, we've skirted around a little bit the ESG one, but I want to drill down into that in a bit more detail. I mean, how much of the loans that you're seeking are ESG related in some way, green finance in some way? How important a part is that for you?
Yeah, happy to spend some words on that. To start with the investment angle, last 2 years for CBRE Investment Management, but also in today's market, the focus has been on resi and logistics. I think on resi it has been standing assets as well as pipeline forward funding assets. Obviously for resi that's really 3 or 4 years ahead, which is difficult in the market with construction cost rising, but still definitely a focus point. Prime locations, core product. Logistics, ideally from a developer, right? It needs to be talking about ESG angle. It needs to be relatively new, if not brand new. Again, standing. We could take a bit of leasing risk. Offices. I say offices is a bit different, right? I think on offices, I think the location needs to be undisputed. It needs to be CBD areas, top 25, maybe 30 cities of Europe. Which is basically the main capitals, right? It's Paris, it's Amsterdam, it's Frankfurt, it's maybe top 3, top 5 of Germany, London. To then take leasing risk, yes, absolutely. Change a single tenant building in a multi-tenant building and at the same time implement all the ESG elements that you'd like. That's definitely what we want to do, even in today's market. We see investor sentiment not equal. Some investors, they as from January, they see the opportunity, they want to go, they want to invest, they bring the equity, however the product is not there, of course. Product is a separate topic. Other investors are a bit in a wait-and-see mode. We try to be bold, we try to invest, but it's easier said than done. Because the product needs to be there, and there's still quite a gap between the asking price and the yield movement to what buyers are willing to pay. Now on ESG and in relation to, and particularly to that, I think we need to go back probably 5, 6, 7 years ago that international corporate banks were sort of the first that could offer green financings at asset level. Nowadays, even the German Pampered banks, who are definitely more conservative in providing that, even they can offer it. We have clearly seen sort of the benefit to do so. And I think over the last 2 years, every new debt that led to a facility agreement, so whether it's a refi with a current bank or whether it's a debt capital markets or whether it's mortgage secured, close to 50% of the debt had an ESG angle. In the past, ESG meant basically only environmental, and maybe at fund level some KPIs, and we call it sustainable, but again, it was focused on environmental. Today, and there was also a team at the Expo, I think to have one KPI relation to social, it's definitely improved a lot. And it's my expectation that it will continue that way as well.
Okay, good. And from your point of view, Oliver, when you're looking at this, particularly for that sort of MPL side, do you expect there to see, the sustainability actually creating some real issues in terms of where, for example, you've already got regulation in the Netherlands, and it will be coming elsewhere, where you just can't let something, even if you've got a tenant who would like to be in the building, if it doesn't reach a certain level. I mean, that's correct, isn't it, Duco?
I think ESG is going to be the norm, right? I think if you have an office building, it needs to be either green today or need to have a green strategy, right? Brown to green, you can leverage that. Maybe nowadays banks will say it's a nice to have, but either the regulator, but in the event the market will demand ESG to be embedded in your strategies, rather than a nice to have and to use as a marketing tool.
Absolutely agree. Also, I mean, I always look from a different angle at the market, right? As an NPL advisor and investor, and sometimes you hear, NPL and ESG, that does not go well together. And in my former life, I was the head of legal for Hudson Advisors Lone Star in Germany. And what we did in the early 2000s, we started with foreclosure proceedings on every loan, cracking the whip at the borrower, and trying to really go after every single loan and borrower. And we learned the very hard way that this is not the best strategy. You have to be prudent, you have to work together with the borrower, and you will make better returns, because sometimes we just got sued, and those court cases, they lasted about 7-8 years, and which did not help on the IRR side. And right now, even on the NPL business, we have the directive for credit service and credit buyers, which has to come in place in every European member state by the end of this year. And according to that regulation, you really have to not harass the borrower, have to try to find a solution with him first before sending him into insolvency. And this is a big part. And we always talk about E, right? But this is S, this is social, this is governance. And I believe NPL and ESG can go very well together. You provide new money into grey buildings. You can build new sustainable properties, and you can work hand in hand with the property and let him live. So this is also in the NPL industry a big issue. And also the investors, they now have to learn. Back in the day, everyone was asking for 2 times multiple returns. Right now, if you do fundraising, which we did with Nexum together, it's every investor tells you, yeah, I want to go into those type of opportunities. But it has to be ESG aligned. And we tell them, okay, we can do that. We can provide new money into those situations, but this will, of course, cost you a bit of return. And to be honest, the investors, they now understand it, especially if you talk to Americans. Right now, they say, okay, it's not 2 times multiple like back in the day, but we have to be sustainable in everything we do, also in NPLs.
Maybe just one addition to the remarks of my colleagues here. Absolutely, I can just confirm that what you are saying, the sentiment of investors has rapidly changed. I'm overlooking, beside Treasury, also the fundraising business of Commerzreal, talking to national but also international professional investors, pension funds, insurance companies, etc., etc. talking with them 1.5, 2 years ago was a different picture than now. So ESG is in our DNA. Each and every asset we purchase, notwithstanding either it's for the retail business or the institutional business of Commerz Real, we have established a due diligence on ESG. So 80 points from environmental, social, obviously as being a subsidiary of a bank, governance is something which lies in our DNA. But saying this, yes, that's something we do, and it's not the question of do we buy an asset, either it's green or brown. It's if it's light green, how is the path for becoming it dark green, and what's the involved cost, capex on that, and that's something what investors are asking us. They are demanding it. It's not just talking about that. It's just what's your plan? Provide me as my investment and asset manager a concrete plan. And saying this, especially on the banking side. It's not only a questionnaire about provide me 5, 4, 6, 7 answers on that and maybe a certificate. I'm very sure every bank we have done last year a questionnaire with 10 of our bigger lender, and the answer was the same. We have a clear picture where our portfolio should look like in 5 years. So we know what's the end goal. But the path on that is something which is not clear. And I see that from this angle, we will get more pressure. The banks will get more pressure. We as an industry will get more pressure. And I think it should be our common understanding to sit together and to move it forward before the tsunami comes to us. Yeah, and it makes a portfolio resilient as well. So it goes hand in hand. NPL and ESG, it's not something totally differently.
And Carlos, from your point of view, obviously you're doing a sale and leaseback, so then you're taking an asset into your own ownership in that sense. Presumably for you, you've got the same issue then, which is that if it's an asset that may be light green or maybe brown or maybe, that you would then need to manage that process, or are you only buying things that are sustainable? Who are you offering that financing to, I suppose?
It depends, really. I would never reject investment because asset is not green. Because if you're buying a manufacturing plant, it's hard to make it green. If you're buying a warehouse, surely you might want to have some solar panels. But what we offer financing to tenants to finance them installing these solar panels. We wouldn't do it for the tenant for the sake of goodwill. But there are different motivations for having green buildings. I think if you speak with Nordic investors, they would say they only buy or they only have approval to buy green assets, and their mandate is only for certain accreditation of greenness, whatever color that is. For us as a REIT, our financing, our debt comes from issuing bonds. And if you have enough assets that are accredited in a certain green level, you can issue a green bond, which is a more attractive term of financing. So we are also motivated to continue to buy green assets. And on the assets that we have, we are motivated to help our tenants make these buildings more green. So the incentives are definitely aligned, but it's not that we're going to go out suddenly and spend our own capex on making these assets green.
Mm-hmm. Okay.
Has to be paid for.
Good. So there's around 5 minutes left. So if anybody's got a question or thought that they want to contribute, do raise your hands. Oh, there is a hand there. Have we got a microphone? Yes, great.
Hello, everyone. Just a brief view on debt capital markets and where you think they're going and possible reopening. Obviously, no crystal ball that anybody has, but just your views would be great. Thank you.
Does anybody want to pick up that in terms of, I guess, when we see debt capital markets fully opening up again, what's the situation?
I'm happy to start. I think debt capital markets, obviously, it's not easy. I think, some say that this year will be a reversion of last year, right? Last year, the first 6 months were fantastic. The second 6 months were closed. How do we see this year? It's a bit like investor sentiment as well on real estate transactions. In my view, if you're going to wait till after summer, and by September you're going to say, hey, I'm there, I'm in the market, whether it's a debt capital markets or whether it's a real transaction, it's not a certainty that you will have deployed your money before Christmas. So I think in general, in the whole real estate market, I think what people want to see is the Q1 valuations on top of the Q4 valuations. The same on the debt capital markets. They want to see issuers showing Q1 valuations. How have they hit so far? Look, comparing Q4 and Q1. Then during the second quarter, investors need to make up their mind whether it will be a loss-making year or they open up for business. If you wait till after summer, you're too late.
Okay, good. Any other views on that? No, that's fine. Any other questions? I shall scan for approximately 5 seconds, which is really till I get to the end of this sentence. Very good. Okay, good. Let's just do a final quick wrap. There's 3 minutes and 40 seconds left, so let's do. So you've got about 40 seconds each. That means no, you haven't got time on that. Let's start, I suppose, on where you're seeing the opportunities here, and I guess. If we're here again at MIPIM next year, where do you expect us to be? I don't mean physically whether we're in this venue or another, but where do you expect the market to be at that point? Let's start with you, Carolus.
I think the risks are for the wider economy, for common households, for a lot of businesses to survive. What's coming, the avalanche of debt increase. It's for me, it's unthinkable that so many people assume that imagine half of the money is debt in the world, half is equity. And of that half money, it went up in price like 5 times. To assume that the world is not going to change is bonkers. So we're going to live in a very different world, I think, very soon. Where the opportunities are, I think, opportunities are for funds like us to do investments. So, when companies need to refinance debt, we come in and do well. So we do well in the downward markets. We do well when companies need to refinance, when they need new debt. I think I took too much time, but yeah, I think a lot of opportunities coming. Yeah.
Okay, great, Oliver.
Yes, well, after last year's Expo of Good Hope, like you said, right? We still pretty much. We woke up being at MIPIM, and everyone is looking for transactions. No one can find product for the right price, for the right financing, and I believe, as an NPL guy, if you are brave enough to acquire via a loan situation, if you're brave enough to work it out, you can also get your hands on good real estate. And we saw plenty of opportunities last year together with some clients, and we found a real estate for a good price, even in this market situation.
Okay, great. Duco.
I think for the prime product, if yields are at 3%, then obviously debt is not accretive. But if the yields are between 4 and 5 and the cost of debt is between 4 and 5, it's not only about driving returns. You also arrange debt to create balance sheet, right? You free up equity to seek other opportunities later in the year. So that's where the opportunity comes from, if you ask me.
Okay, great. And final word to you, Barker.
I hope for less volatility. I think we are in very dynamic markets, and the situation somehow is there to stay for longer. So at least that we have probably then seen the peak of interest and inflation hikes, so that we have a little bit more security in calculation our business models and rely on that. That's what we hope, and also a collaboration or more collaboration between the renewable energy industry with real estate.
Okay, great. Thank you very much. There's the next session, as I mentioned at the beginning. This is a series of 4 events. This was the 3rd one, and the next panel is going to be on a kind of quick 40 minutes zip through ESG, some of the key trends around that, livable cities, and what that means. Quite an interactive event. That will start in approximately 2 minutes. So in the meantime, if you could join me in thanking the speakers and yourselves, that would be great. Thanks, everybody.
Thank you.